Western economies are going through a period of rising political tension and instability. There's growing anti-authoritarian sentiment, with more people distrusting government institutions and leaders. This is especially visible in the US, Canada, and Europe, where elections, protests, and policy uncertainty are shaking investor confidence. From a market perspective, this leads to a risk-off environment. Investors are pulling back from riskier assets and putting more money into safe-haven currencies, like the US dollar. At the same time, global military spending is rising fast. NATO countries have committed to much higher defense budgets, signaling that geopolitical tensions are not going away anytime soon. Historically, these types of militarization trends coincide with economic stress and market volatility. This adds to the uncertainty and keeps investors cautious. For currencies, this matters. The U.S. Federal Reserve has kept interest rates higher than Canada's central bank, and with Canada expected to cut further, the U.S. dollar is more attractive for investors. That interest rate gap helps push U.S. dollar to Canadian dollar higher. Canada is also facing new U.S. tariffs and slower growth, which weakens the Canadian dollar in the short term. However, high oil prices, driven by global conflict, support Canada's economy and give the loonie some strength. Putting this all together, the US dollar to Canadian dollar exchange rate is expected to stay strong through the summer, possibly reaching around 1.37 to 1.38. As we move into the end of the year and into 2026, if the Fed starts to cut rates, and if global risks ease a bit, US dollar to Canadian dollar could trend lower, maybe into the 1.33 to 1.35 range. The key factors to watch will be central bank policy, global conflict, oil prices, and whether Western political systems calm down or remain unstable. Subscribe, like, and comment for more from Economics Now.